Hi guys, this is Crowd Investing. Today we're going to talk about the secret of building a low risk and high return portfolio. Sometimes you might think that how can the S&P 500 is keep going up in the last few months, but my portfolio is keep going down. What is happening? Or S&P 500 gain about 10% up to year to date, but my portfolio is only gain about 3 to 4%. So we're going to talk about how to build a low risk and the high return portfolio. Okay, this is the comparison between the S&P 500, Nasdaq, and Dow Jones. You can see that from this year, 4th January until now, the S&P and Dow Jones is gaining about 14 to 15%, but you see the Nasdaq is only gaining about 7.7%. So Nasdaq is actually lower than the S&P and the Dow Jones. If you are holding more stock like Nike or Bank of America, those that are inside the S&P and the Dow Jones, you will have a fantastic portfolio. But if you are holding more technology stock like Amazon, Microsoft, then your portfolio might not grow so well in this year. Okay. Yep. So you can see that this one is the whole years. You can see that from last year May until now, the Nasdaq is actually more than the S&P 500. So that we conclude that this is the seasonal rotation. Sometimes the Nasdaq will do well, sometimes the SPS will do well. So we have to create a portfolio is to include everything. So the key to create a successful portfolio is actually a diversification. So how to diversify? You have to diversify into the different countries like US, Singapore or China, and different sector and the different categories. We'll talk more about this later. So you can divide your capital into the 10 to 15 stock. Let's say you only have about $10,000, and then you can divide your capital into 10 stock. Then each stock will be around 10,000. So each stock will be around $1,000 value. Then you must divide as balanced as possible. So okay, this one is one of the example from my portfolio. You can see that in my portfolio, I have Microsoft, QQQ, SPY, SHI is a China ETF, Salesforce, Adobe, Alibaba, McDonald's, SPGI, and so forth. You can see that in this portfolio, right, I have a big allocation in the Microsoft, QQQ, and SPY, and the SHI, the China ETF. Then the Facebook, the ARK ETF, the GSC is another China ETF, is more small. So from there, I can know that, okay, I have to increase my allocations into the Facebook. The way I can do is maybe I can sell some of the Microsoft and then transfer the money into Facebook, or I can top up the new money, the fresh fund into my account and then buy more Facebook share to be balanced back. Then you can see that from this portfolio, right, is quite balanced between the ETF and the stock because I don't want to be so high risk for this portfolio. So I include the ETF. The ETF is about 40% and 60% is the individual stock. So this portfolio I will say is risk, but it's not the high risk. So, but in terms of growth, the portfolio will also grow very well because you see that QQQ and Microsoft might not do very well, but SPY will do very well in this period. Yes, SPY, SPGI will do very well. So, okay, just now we talked about to diversify. We have to diversify to the sector, right? So this is a chart that you can see that from the last year May until today that all the sector from the SPDR, you can see that the finance SLF is actually the strongest in the last year. Then the technology SLK, right, is actually not the highest. Then even the energy also almost the same with technologies. You can see that the energy is a blue color. Until the last year end, right, energy is on a downtrend, but suddenly in this year, energy is all the way going out. And then the technology, the black color one, you can see that from here, right, it's starting to move like sideways or going down. So that in order to create a winning portfolio, you need to diversify your portfolio into the different sector. So the sector can actually divided into three different categories: defensive sector, cyclical sector, and the moderate cyclical. So in the defensive sector, right, is those companies that sell the product or services, there is necessity, means that you must use their product no matter what. Most popular is a healthcare, it's like the J&J, UNH, and ABT. These are the top three that in this sector. Means that no matter what, you still have to buy the baby product through J&J because J&J is a brand monopoly in the baby product. And then you also, a lot of the medical hospital also using the Johnson & Johnson medical product. Then the consumer staple is those that manufacture the food and beverage and the household or personal product like Procter & Gamble, Colgate, Coca-Cola, and PepsiCo. Then the utilities is no matter what, you still have to use the utilities from your company. From your country. So those utilities are the electricity or the gas or the water utilities. The example will be the DUK, SLC, and the NEE. Okay, after the defensive, you need to have some cyclical stock in your portfolio. Cyclical stock is the company that don't sell the product or services for a luxury. Means that during the economic bad time, the cyclical sector will be affected a lot because nobody will buy the luxury product. They will save more money. During the economic good time, people will spend more money. So the cyclical stock generally will be go up and down very much. The basic material is the first one. Those that manufacture the chemical, the Dow is one of the big company in the basic materials. Finance sector is the very cyclical sector. So finance sector is they provide the financial service including bank, asset management. The most popular is JP Morgan, Bank of America, Goldman Sachs, and the MasterCard. Energy is also considered a cyclical sector. There is the ExxonMobil. Real estate is also considered a cyclical. Some real estate can be the defensive, but it depends on what kind of the asset management it is. Moderate cyclical means that they are not that cyclical and also not that defensive. They are in between. So what is that? Is technology. Technology, some people might think, how can technology is not a cyclical or defensive? Because technology, sometimes there is a bad time, but the company still have to use a software, like the Apple. People still have to use the Apple computer. Microsoft, no matter good or bad time, people still use Microsoft. Adobe software also, CRM software also. So technology is considered a moderate cyclical. Industrial also, consumer discretionary also. The communication service is also considered a moderate cyclical. So how to create a portfolio that is balance between these three? So you can see from this one. From this example, right, this is one of my portfolio. It's very balanced. In this portfolio, I have the Google, Alibaba, United Health, Procter & Gamble, JP Morgan, Bank of America, Microsoft, and McDonald's. Okay, you can see they are quite balanced. Each of the stock is holding about 10 to 15%. It's not more than 15. Yep, this one slightly more than. And then in their sector, right, is also quite balanced. You can see that in here I holding JP Morgan and Bank of America, but both together, right, is about 14.33% in my portfolio. So there is finance sector is about 14%, then technology is about 14, consumer cyclical 13, and so on. You can see that this is a very balanced portfolio. Let's say now the Microsoft is not doing well because going down. Alibaba not doing so well. Google also going sideways. But my Bank of America and JP Morgan is going up. My United Health is going up because they are the difference. This one is considered cyclical. This one is considered a healthcare. Yeah. Then you can see that my Procter & Gamble is also going up well. The McDonald's is also going up. So that in order to have the portfolio there for the all weather, right, you need to be diversify very well and control very well. That's why I say that try to divide your stock to as balanced as possible. You will never be 100% be balanced, but as balanced as possible. So now we're going to the categories. So some of the stock have the different categories. So we have total 7 categories in here. So the first one is a dividend cash cow. This one is you once you buy the stock, you have to think what is your purpose to buying it. You want to have the capital gain or you want to have the collecting the dividends. So if you want to collect the dividends, the dividends must be at least 4 to 5%. And then the stock must be have the very stable share price, will not like the cyclical. So risk stock will be the good one. Large cap predictable. Large cap predictable is the big companies that they produce a product that you need to use regularly, like Colgate, Procter & Gamble, United Health, and Johnson & Johnson. Large cap growth company. Most of the company in these categories is considered a technology stock. It's like Alphabet, Amazon, Facebook, Alibaba, Adobe, or Microsoft. Because they are the technology company, so they have the high future growth rate, and then they are the very big company in the market, right? Most of the time, they are the market leader. Speculative growth stock is the company that have the high growth future, high potential, but it's not yet profitable. Means that you don't know what will happen to them, but for currently they have the very high growth rate by those analysis. The example will be Zoom Video, Beyond Meat, or Snowflake. The next one will be deep cyclical stock. Deep cyclical stock is that they will be greatly affected by the economy news. Like if the inflation is going up, then the bank stock will be very affected. If the inflation rate is going down, the bank stock will also affected. So how the economy news right coming out will greatly affected those that in the deep cyclical stock. The turnaround stock is that being hit by the temporary bad news, but they are still the good company, just that they are being hit, so their price going down. So the good example will be Boeing, BA, Booking.com. Booking.com is being affected by the air travel. Everyone cannot travel out to the country, and then cannot book the hotel, so those hotels shut down, then Booking.com is also affected. Then the Alibaba also considered one of the turnaround stock, because Alibaba, the M Financial, their last year IPO being stopped in the last minute, so everyone is going to see what is happening to the M Financial. So they are being hit by the temporary bad news, but for the future they can grow well because their business, their fundamental is not affected, just the temporary only. Then the last one is the index sector or industry ETF. Of course, you can have the ETF in your portfolio. Sometimes that you do not have so much money to buy the particular stock, like Amazon can be $3,300 per share. You cannot buy, then you can buy the ETF. They're holding all the technology stock. Yeah, or you do not have the money to buy the United Health. You just buy the ETF, the SLV will be good enough. Okay, so this is all for today. Hope that you can build a very fantastic portfolio, and then your portfolio can be doing very well. If you like our video, you can subscribe and then please like our video. Thank you very much. Bye bye.